$10,000 every month without lifting a finger. It's the number that haunts every investor's dreams. The magic figure that promises freedom from the 9-to-5 grind, the holy grail of passive income. But here's the uncomfortable truth the gurus skip over. The path to $10,000 a month, it's built on comforting myths, optimistic assumptions, and mathematical realities that would make most people reconsider their timeline entirely. But here's the thing, the game isn't rigged, it's just harder than they make it sound. Today we're breaking down the real mathematics of passive income. 3 levers: time, savings rate, and risk, taken with eyes wide open. Let's start with the most popular rule of thumb in finance. You've heard it 1,000 times. The stock market returns 10% annually. And technically, they're not wrong. Since 1928, the S&P 500 has averaged 9.96% annually, almost exactly 10%. But here's where the math gets uncomfortable. That's before inflation quietly erodes your purchasing power. After accounting for the rising cost of everything you actually need to survive, that 10% becomes 6.69%. Picture this. You invest $100 in 1957. By May 2025, you'd have $82,000 in your account. Sounds incredible, right? In real purchasing power, that's worth just $7,100 in today's money. Inflation, the hidden tax on your financial dreams. And it gets worse. Remember when companies actually rewarded their shareholders generously? The average S&P 500 dividend yield in 2024, just 1.3%. Your grandparents could live comfortably off dividends. Today, that's just not the reality for most portfolios. Enter Bill Bengen, a financial planner who, in 1994, introduced what became known as the 4% rule to the world. His research suggested withdraw 4% of your portfolio each year, adjust for inflation, and your money should last 30 years. For 3 decades, this rule dominated retirement planning. It became conventional wisdom. But in 2025, Bengen himself delivered a significant update.
And you're using a portfolio of 60% stock, 40% bonds. There's actually a range between like 45% stocks and about 75% stocks, where you would get the same 4.7%. I've increased that to 4.7%.
0.7%. It sounds tiny, but for someone chasing $10,000 a month, this changes everything. Let's do the math together. At 4% withdrawal, $10,000 a month needs $3 million. At 3.7% withdrawal, $3.24 million. At 4.7% withdrawal, $2.55 million. What's your number? If your rent is $2,000 and you need only $6,500 a month net, type it in the comments. I'll pick one and build a plan around it in the next episode. But wait, there's a crucial twist. While Bengen was getting optimistic, the analysts at Morningstar were examining the same data and reaching a very different conclusion. Their 2024 recommendation? Just 3.7%, due to higher equity valuations and lower fixed income yields. Same data, same markets, completely opposite conclusions. And here's what neither side talks about enough. It's not just the average that matters. It's the order of returns. 2 retirees with identical average returns can have vastly different outcomes depending on whether they hit bear markets early or late in retirement. Let's break down the capital requirements for different risk approaches to financial freedom. Playing it ultra safe with 2% annual returns? You'll need $6 million to generate $120,000 yearly. $6 million. Most people don't accumulate $6 million over their entire career, let alone have it available to invest. Following the updated 4.7% withdrawal rate with proper diversification, $2.55 million. Still substantial, but achievable for dedicated savers over 25 to 30 years. Banking on that historical 6.5% real return from stocks, $1.85 million. Getting more accessible, but here's the critical reality check.
Watch out, excuse me.
5 years ago today, the government faced one of the biggest financial crises in history.
CNBC trading down $1.30 right now at $17.50 a share. Of course, it's lower open expected, and
those average returns, they come with decades of volatility, market crashes that can wipe out 30 to 50% of your wealth. And the psychological challenge of staying invested when everything looks bleak. Targeting that nominal 10% return without adjusting for inflation, $1.2 million. But remember, inflation will steadily erode your purchasing power. Your $10,000 today might cover a week of groceries in 20 years. Whole time, Bengen's 4.7% versus Morningstar's 3.7%. Which would you plan with? Drop your choice in the comments. Just buy dividend stocks, they say. Get paid to own great companies. To earn $120,000 annually from dividends, 4% yield, $3 million needed. 6% yield, $2 million needed. Sounds reasonable, right? Here's what gets overlooked. Yield doesn't equal total return. High dividend yields often come with lower growth potential or higher risk. Companies don't pay high dividends because they're generous. They often pay high dividends because investors demand compensation for higher risk or limited growth prospects. The truly reliable dividend payers, they focus on dividend growth over current yield. Dividend aristocrats average 2.25% yield, but have grown payouts for 25 plus consecutive years. To get your $120,000 from these reliable growers, you'd need $5.3 million. What about those flashy covered call ETFs and REITs promising 8 to 12% distributions? High distributions, yes, but watch the total return and tax drag. Many trade current income for long-term growth. Real estate, the alternative path where some claim you can build serious passive income with less capital. One popular case study from a well-known FIRE forum, an investor claims to generate $10,000 monthly with $500,000 invested in single-family homes. The strategy? Buy undervalued houses in affordable markets. Renovate strategically, rent them out, scale over 6 years. Sounds straightforward, right? But here's the math they don't always highlight up front. Your spreadsheet's 7% cap rate quickly becomes 3 to 4% after capital expenditures, property taxes, insurance, maintenance, and inevitable vacancy periods. And that passive label, it comes with 3 a.m. emergency calls, tenant management, legal compliance, and market risk that can't be diversified away easily. Want truly hands-off real estate exposure? You're looking at commercial properties, REITs, or real estate syndications. The capital needed varies dramatically, between $870,000 and $2.6 million, depending on leverage, property type, and location. Commercial real estate can offer attractive returns, especially with triple net leases where tenants handle expenses. But vacancy risk, refinancing risk, and illiquidity are real considerations. Remember, real estate isn't immune to economic cycles. Just ask anyone holding commercial properties in 2008 or retail real estate in 2020. But Let's step back. Say you reach your target. You've got consistent passive income flowing in. You've achieved financial independence. What then? While different studies suggest various income levels for optimal well-being, the consistent finding is this: money's impact on happiness has diminishing returns. Maybe that's the real goal. Not the $10,000 itself, but the peace of mind that comes with having enough. The freedom to choose work you find meaningful rather than work you need for survival. The question isn't just, how much do I need? It's, what kind of life am I building toward? So what's the realistic range for achieving $10,000 a month in passive income? For a relatively safe approach using modern withdrawal rate research, you're looking at $2.5 to $3.2 million. Willing to accept more market risk with historically based assumptions? $1.8 to $2.5 million. Taking on significant risk with optimistic return assumptions? $1.2 to $2 million. But here's what's more important than the destination: understanding the journey. A couple saving $50,000 annually with 7% average returns reaches $3.2 million in 25 years. That same couple saving $75,000 annually gets there in 20 years. The path isn't just about the target amount. It's about optimizing your savings rate, tax strategy, investment approach, and timeline to match your values and risk tolerance. Let's be honest, the median American household has less than $65,000 in retirement savings. Even $1.2 million feels like climbing Everest, but here's what the data also shows: it's not impossible. Thousands of people build substantial wealth through consistent investing, strategic career moves, business ownership, or real estate, often using a combination of approaches. Starting at 25 with a $50,000 annual savings rate, you could reach $2.5 million by age 50. Starting at 35 with the same rate, you'd reach it by 55. Starting at 45, it's still achievable by 62 with some aggressive saving and smart investing. The key insight isn't about hitting an exact number. It's about understanding the trade-offs and making informed decisions about your timeline, risk tolerance, and lifestyle. Financial independence isn't built overnight. It's constructed one decision at a time over 20, 30, or 40 years. Every dollar you invest today, every expense you optimize, every skill you develop that increases your earning power, every smart tax strategy, it all compounds. So here's your homework. What's your target monthly passive income? Not $10,000, your number based on your actual expenses and goals. Drop it in the comments below. I'll pick the most interesting one and build a complete roadmap in our next episode. And vote. Are you Team Bengen, 4.7% withdrawal rate, or Team Morningstar, 3.7%? Your choice reveals a lot about your risk philosophy. If this deep dive into passive income math opened your eyes to both the challenges and possibilities, hit subscribe and ring that notification bell. Because building wealth, it starts with understanding exactly what you're up against. The $10,000 dream isn't dead, but it does require a plan that's grounded in financial reality, not wishful thinking. Your move.